James Finelli with Wall Street Journal reports that New York City is facing a tax deficit of up to $12 billion over the next 2 years. This is a particularly big issue because governments work a lot like regular businesses do, or even you and I. They have to have income, which is generally seen as tax revenue, and then they have to use that money as appropriations or other expenses that they do, such as social programs, etc. This deficit puts a lot of these things in jeopardy, especially when it comes to some of the promises that Mayor Mamdani has had, such as wanting to make buses free, institute more government-controlled grocery stores, etc. A lot of these issues are not necessarily just because of the lack of tax revenue coming in. We have to think about this from a larger standpoint. New York City has been recently facing issues with a diminishing tax base. This is that a lot of high earners have been recently leaving the area, and a lot of businesses are moving their headquarters out of that city as well. With a lower tax base, that is, lower revenue coming into the city, these programs are being strained, and some of them will have to stop. Ultimately, though, this is an issue that all governments face, regardless of which economic system their leadership subscribes to. Companies face these same issues as well. How can we maximize our revenue and minimize our expenses while still operating in the way that, in a government's case, our constituents want us to? This overall issue speaks to a lot of different things. A lot of governments have a system in place called a bidding system, where whenever a new contract comes up or another need for the government, they require potential vendors to submit a bid. In theory, this is supposed to lower the overall cost of these services as much as possible. In reality, it doesn't quite work that way. Therefore, a lot of governments tend to bring in additional revenue in other ways, whether it be through fundraising, private donations, lobbying even, or even political action committees and other methods of income. I want to talk a little bit more about what this means for the average person, though. Either your tax rates are going to go up, or you're going to see a cutback of some of your services. Strangely enough, when it comes to raising the tax rates in order to cover this shortfall or this deficit, it's not always that simple. A great economist created what is known as the Laffer Curve, which is essentially this idea that says, as you increase the tax rate, you don't always see an increase in total taxes accepted. The reason for this is, at a certain point, some of the people who make up the constituents and contribute to that tax base tend to leave the area. Another reason is that even the people that stay in the area are less incentivized to work. So instead of putting in, say, 60 hours to get a startup or small business up and running off the ground and profitable, they may not start a small business at all. Or for people who are on salary or wages and are high earners, instead of putting in 60 hours and contributing to the economy, they may scale back their work to 40%. Just because the tax rate at that point is too high and they don't consider it worth putting in the additional time. Their quality of life is not improving relative to the amount of work they're putting in. Again, the Laffer curve is what demonstrates that idea of diminishing tax returns. On the other hand, as we said, if you are one of the people who are living in the confines of New York City, you may see your services decrease. The reason for this is, of course, all of these services cost money to run. You need resources to run a government, and you have to allocate those resources appropriately. As we move forward, we have to start looking at businesses, individuals, and governments in a very similar way. We're all corporations. We all have income requirements, and we have outgo requirements. We all need resources, and we have to allocate them accordingly. Moving forward, what you do as an individual should be based on what your budget can be. Balance your budget as much as possible, save as much as you can, and prepare for the future.
A new study out of George Mason University, published Friday in the Wall Street Journal, looked at 35 years of data comparing fixed rate and floating rate bond funds. What they found was that over the full period, floating rate debt slightly edged out fixed rate. averaging about 4.88% annually versus 4.86%. But when they broke it down by interest rate cycles, things got a bit more interesting. During periods when the Fed was raising interest rates, floating rate funds returned nearly 5% a year with lower volatility, while fixed rate funds lagged behind at under 2%. Flip it around to rate cutting periods, though, and fixed rate funds crushed it, returning over 6.3% versus just 1.67% for floating rate. What does this actually mean for you right now? The Fed has been in a cutting cycle, and markets are watching closely for what comes next. If you've been sitting comfortably in floating rate debt, this research is a yellow flag. When the Fed pivots to quantitative easing, your floating rate incomes drop right alongside those benchmark rates. Fixed rate fall. The bigger takeaway here is that most investors just default to fixed rate and never think about it again. This study is saying to be more intentional. Pay attention to where we are in the rate cycle and be willing to shift. It's not about picking one forever, but it is about matching your bond allocation to the macro environment. So, to bring this story all together, new research shows that the choice between fixed rate and floating rate bonds isn't one you should set and forget. Floating rates shine when the Fed is tightening. Fixed rate takes the crown when rates are heading down. Over the long run, the returns are nearly identical, but timing your allocation to the rate cycle can give you a meaningful edge. You need to know what the Fed is doing and position your bond portfolio accordingly. Don't just be a passive passenger in your fixed income strategy. Wall Street had a rough Thursday, and it wasn't because of earnings misses or rate fears. It was AI anxiety. According to the Wall Street Journal, the S&P 500 dropped 1.6%, the Dow fell 1.3%, and the Nasdaq led losses down 2%. But this wasn't just a tech story. AI disruption fears rolled through sector after sector throughout the week. Insurance brokers got hit Monday on news that OpenAI was building a homeowner insurance quote app. Wealth managers and brokerages fell Tuesday on an AI tax planning tool. Software companies like Salesforce, PayPal, and Thomson Reuters sold off on news of an AI assistant handling legal and research tasks. Even trucking and logistics companies got hammered. The Dow Jones Transportation Index lost over $17 billion in market value in a single day. Meanwhile, a Magnificent 7 ETF officially entered correction territory, dropping 10% from its October highs. Investors fled to safety, pushing the 10-year Treasury yield down to a 2-month low. Here's what's really happening beneath the surface. For the past 2 years, AI was the reason stocks went up. Now, it's becoming the reason certain stocks go down, and not just tech names. The market is starting to price in who AI disrupts, not just who builds it. Insurance, wealth management, logistics, legal services. These are all industries where investors are suddenly asking, what happens to your margins when an AI can do all for a fraction of the cost? The rotation is telling too. Money is flowing into consumer staples, utilities, and treasuries. The classic defensive playbook. As one portfolio manager put it, the market's mentality right now is shoot first, ask questions later. That kind of reactive, fear-driven selling can create both danger and opportunity. The danger is that good companies get sold off immediately. The opportunity is that if you're watching closely, some of those names may be oversold. So to wrap it up, AI disruption fears are no longer just a tech sector story. They're hitting everything from trucking to financial planning. Investors are rotating hard into safety. The Magnificent Seven are in correction territory, treasuries are rallying, and Wall Street is scrambling to figure out which industries are next in the crosshairs. The takeaway for your portfolio? The AI trade has officially become a two-sided coin. It's not just about who benefits anymore, it's about who gets left behind.
Thanks for watching this week's Finance Roundup. Please like the video and subscribe to the channel. We'll meet you back here on Saturday for the next episode. Have a great weekend.